The broadcast is now starting. All attendees are in listen-only mode.
Welcome to today's webinar covering our assessment of the latest market trends and issues in the ports and terminal sector. My name is Dinesh Sharma and I'm joined today by my colleagues Eleanor Hadland and Eirik Hooper, the authors of the most recent edition of Drewry's annual review of global container terminal operators. We've prepared some slides for you. We'll take about 20 minutes to go through the slides, after which there will be a Q&A session. If you would like to ask a question, please do so via the questions panel on the screen. You can do this at any point of time during the webinar. We will aim to answer as many questions as we can at the end. To preempt the most commonly asked questions, yes, we will be sending out a recording of the presentation and a copy of the slides. Let me now hand over to Eleanor to start the presentation.
Thank you very much, Dinesh, and good morning if you're in the US or elsewhere in North America, Latin America, or good afternoon if you're with us here in Europe. Thank you for joining today. So the agenda for today's presentation provides selected highlights from our recently published annual review of global container terminal operators, which is the first topic that I'll be talking about. And then Eirik will provide the highlights from our Ports and Terminals Insight report that we published at the end of August, which includes our Global Ports Monitor, tracking performance of the market, some updates on the financial performance of the leading companies and the latest news on deals and developments. Dinesh will then give some conclusions. And as he indicated, we'll be wrapping up with a question and answer session. Now, the principal source of material for our webinar is our Ports and Terminals Insight subscription publication, which is a quarterly report with in-depth analysis, which is joined with a monthly data supplement providing enhanced global and regional data. And then our flagship presentation report is our Global Container Terminal Operators Annual Review and Forecast, the 2025-26 edition, which was released at the end of July, has our well-known league tables and gives a performance of all the leading terminal operators, both those that are operating globally and the leading regional operators. So I'll move straight on to deal with the findings of our annual report into these global operators. Now, hopefully many of you are familiar with the Drewry League table. I'll just switch my camera off so you can focus on the slides. So if you're familiar with the Drewry League tables, you'll know that we produce three main rankings, and these tables provide a like-for-like comparison of global terminal operators on the basis of their total throughput, their equity-adjusted throughput, and the capacity of their portfolios. Now, on this slide, we're presenting a summary of the equity-adjusted throughput for each of the 19 companies which qualified as global operators in 2024. And for this metric, throughput is adjusted pro rata to the shareholding that each company has in each terminal within their portfolio, but the numbers also include throughput generated via shareholdings in other terminal operating companies, and this is shown in the gold color on the bars. Now, these 19 global operators reported equity-adjusted throughput of over 456 million TEU in 2024. That was equivalent to 49.2% of global port volumes, up from the 48.9% share that these 19 companies held in 2023. The composition of the league tables actually changed in 2024, with Ocean Network Express, or ONE, qualifying for inclusion in the global league tables, but MOL, NYK, and Yangming dropped out of the rankings since they no longer met the throughput criteria for qualification. The largest absolute increase was recorded by PSA International, which retained the top spot in the rankings, and its equity-adjusted throughput reached 67.2 million TEU, which was up by over 7% on a year-on-year basis. China Merchants held on to second spot with equity-adjusted throughput of 61.2 million TEU, and despite only recording a 0.9% increase, China COSCO Shipping remained in third place with equity-adjusted throughput of 54.2 million TEU. ONE entered the rankings in 15th position with 4.6 million TEU of equity-adjusted throughput. And for those that tuned in last year, it's important to note that all of last year's new entrants reported above average growth. Hanseatic Global Terminals doubled its equity-adjusted volumes to reach 4.4 million TEU. Adani's equity-adjusted throughput rose 14.5% to 7.4 million TEU, and AD Ports reported a almost 39% growth increase to reach 3 million TEU. For those of you that regularly attend our webinars, then you'll be aware that in the wake of the pandemic, several of the largest carriers have made significant investments in the terminal sector, expanding their portfolios via a combination of investment in existing assets, greenfield projects, and via M&A. In this chart, we show a five-year performance, the five-year performance of the top 10 global operators, identifying which have outperformed the market and which have underperformed. So in the period between 2019 and 2024, we saw a 15% increase in global port throughput, but only 5 out of the top 10 operators outperformed this level. CMA CGM's equity adjusted volumes have grown by a really impressive 55%, or 4.6 million TEU since 2019. But overall, this is dwarfed by MSC's addition of 14.1 million TEU, a 47% increase in its equity adjusted totals over that same 5-year period. Only China Merchants Ports Group recorded a larger increase in its equity adjusted volumes, up 48% or 19.7 million TEU. But this has been achieved largely on the back of increasing its shareholdings in other Chinese port groups, having only made one overseas investment since 2019. In contrast, MSC and CMA CGM have increased both the scale and geographic scope of their portfolios, making some significant acquisitions along the way. And recent deals mean that they're likely going to continue to outperform the market for at least the next 2 to 3 years. I think an interesting point to note is the performance of ICTSI and Yieldport, which, while the percentage increase in equity volumes is very high, the absolute increase is far lower. And this is just due to the smaller scale of these companies. What's notable, however, is that these two independent terminal operating companies follow very similar strategy. They've been investing in small to medium-sized, primarily gateway ports, often in multi-purpose terminals, and typically are investing either on a standalone basis or with a local partner holding only a minority share. And these companies don't shy away from emerging markets, seeing the growth opportunities here. But one thing we did highlight in the report is they're facing much increased competition for concessions from new entrants into the rankings, including AD Ports and Adani. I'll move on now to look at the capacity outlook for the global operators. So how will the global operators' portfolios develop over the next 5 years? I think it's important to note here that we're providing this analysis before taking into account the impact of any deal for the Hutchison Ports portfolio, as this deal isn't yet far enough advanced to factor into our capacity forecasts. So COSCO currently operates the largest portfolio, but we're measured in terms of capacity, but we do expect PSA to move into the top spot by 2028. We also look at how the global operators will deliver these capacity increases, and our research found that around 60% of the projected gross capacity increase will be organic. That's expansion of their existing terminal assets. Greenfield projects will account for just over 20% of these capacity increases, with 17% attributable to confirmed M&A activities. And obviously this M&A proportion may increase if a large-scale deal such as the Hutchison one progresses within the 5-year timeframe. We also undertook our usual performance benchmarking exercise, and each year we surveyed the industry to establish the intensity of asset use. Our latest survey included over 450 terminals, which together handled 74% of the global container trade. The average terminal in our sample handled 1.5 million TEU in 2024. It had an average quay length of just over 1,200 meters, operated with 10 ship-to-shore gantry cranes, and was operating on an area of 55 hectares. Benchmarks moved up in 2024 on the back of stronger demand, and when we take a longer-term view of operational performance, we can see this trend more clearly. So over the past decade, we've seen the intensity of both use of berth use and ship-to-shore crane use increase. So the global benchmark for the intensity of quay use has increased 7%, from around 1170 TEU per metre of quay in 2014 to almost 1,250 TEU per metre of quay in 2024. And for ship-to-shore crane use, this has risen from 130,000 TEU per ship-to-shore crane to over 150,000 TEU per crane over the same period. We attribute this primarily to improved crane technology, including increased use of twin-lift spreaders, automated container landing systems, and other operator assistance functionalities, which have contributed in the main to this growth in key performance metrics. However, we highlight that this can only be sustained if there's a corresponding investment to upgrade yard equipment and terminal operating systems. the global benchmark measuring the intensity of land use increased 24% from around 25,000 TEU per hectare in 2014 to over 31,000 TEU per hectare in 2024. Intensification of yard operations has been achieved via changing the mode of yard operation and increasing the stack density by deploying, for example, higher stack RTG systems. Additionally, accompanying this, we've seen advances in terminal operating systems and wide-scale introduction of vehicle booking systems, which have also enabled yards to be operated at higher densities. I'll now hand over to Eirik, who'll summarise the findings from our latest Ports and Terminals Insight Report.
Thank you, Eleanor. I'll now provide an update on the year-to-date performance and the outlook for the terminal sector. So although the rolling four-quarter growth rate dropped slightly in the second quarter of 2025 to 6%, this is still well ahead of our earlier expectations, aided by front-loading in the first half of the year in advance of the imposition of US tariffs. However, there remains considerable variation in throughput growth between regions. In Greater China, the growth rate slowed, falling to 5.8% from 6% recorded in the first quarter. At a port level, Shanghai reported a 6% increase and handled nearly 14 million TEU. Ningbo also had a robust quarter, with volumes rising by 1 million TEU year on year to handle 11 million TEU in the second quarter of 25. Conversely, volumes at Hong Kong continued to decline, down 8.2% quarter on quarter, with the throughput of 3.1 million TEU being the lowest recorded in the last 15 years. The rolling four-quarter growth rate at North American ports slowed to 8.3%, down from 10.7% in the first quarter, with tariff uncertainty beginning to impact throughput figures by the second quarter. And in the Latin American market, the growth rate also slowed, down to 9.2% in the second quarter of 25, compared to the first quarter number, which was 11.2%. Elsewhere, our sample of South Asian ports recorded a growth rate of 10% in the second quarter, slightly below the 10.3% recorded in the first quarter. JMPT and Colombo experienced record-breaking second quarters, with 15.6% and 8.2% year-over-year growth, respectively, with both ports handling around 2 million TEU in second quarter 25. Meanwhile, the European market continued to improve, with a rolling four-quarter growth rate of 5.6% in the second quarter 25, up from 5.1% recorded earlier in the year. Looking forward, we still retain the view that global container port handling will slow down in the second half of the year. But after a stronger than expected first half, buoyed by this front loading, we have upgraded the annual growth prediction for the full year 2025 up to 3.3% from 2.7% in the previous edition. This equates to 31 million TEU over the 928 million TEU global port volumes reported in 2024. With the delayed introduction of tariffs, the outlook for 2026 is for lower growth of just 0.8%. But of course, there remains the caveat that US tariff policy provides major uncertainty for these forecasts. In August, we upgraded the outlook for all world regions except for Africa, where growth is expected to be just 1.2% in 2025, and North and Southeast Asia, where we held the 2025 forecast steady at 3.9%. Growth in port throughput in Greater China is forecast to fall to 3.2%, well below the 6.8% growth recorded in 2024. Nevertheless, Greater China will still account for 30% of the forecast increase in global port handling. North American volumes are forecast to grow by just 3% in 2025, again, a much lower performance than the 11.1% growth seen last year. Middle East and South Asia is the only market where we have forecast improved performance in 2025 compared to 2024, largely due to the lower base from the impact of the Houthi rebel attacks on Middle East shipping in the Red Sea and the impact that had on Middle East region ports in 2024. We also update our regional capacity and utilisation forecast in each edition of the Ports and Terminals Insight. Global container port capacity is forecast to grow at an average annual rate of 2.4% from 2024 to 2029, reaching 1.5 billion TEU by 2029. This represents an increase of 169 million TEU over the estimated 1.33 billion TEU of terminal capacity in operation in 2024. And globally, average utilisation is expected to rise to 69% by 2029. Capacity in Greater China is expected to grow from 356 million TEU in 2024 to 385 million TEU in 2029, with utilisation forecast to increase from 88.1% to 91.2% during the same period. These figures in our database includes nearly 6 million TEU of additional capacity in Shanghai alone, and the 3 million TEU capacity Yantian East terminal, which will open later this year. In our quarterly report, we published 3 indices that track revenue, costs, and earnings on a per unit basis for the global container terminal sector. With results in for the first half of 2025, we saw a marginal decrease in the revenue index, primarily led by APM terminals, where volume growth outpaced revenue increases, reducing revenue per TEU. Likewise, Westport's revenue per TEU was also lower due to an unfavourable volume mix, with transshipment trade outperforming gateway traffic. Although the cost index dropped slightly on a sequential basis, on a year-on-year basis, it increased 3.6%. Costs are projected to continue to increase on a year-on-year basis as the impact of inflation-linked labour agreements signed in 2024 continue to flow through into the financials. The earnings index declined 4.1% quarter-on-quarter, but gained 6.4% on a year-on-year basis, which is in line with the trends witnessed in both the revenue and cost indices. The earnings index is likely to contract over the remainder of 2025 as revenue prospects remain uncertain, while costs per TEU are expected to continue rising. In the quarterly report, we also track the latest deals and developments in the sector. While much of the news flow is dominated by the Hutchison port sale, we also monitor and analyse other development opportunities. Official announcements relating to the Hutchison deal have been brief, while debate in the trade and mainstream press has been much lengthier, so a lot of speculation in the market. In response to the reports that COSCO and CMA CGM are also interested in the portfolio, it is not clear to what extent this might squeeze out MSC and BlackRock. The inclusion of COSCO in the deal will likely raise regulatory approval difficulties elsewhere, not least in the purchase of the 2 Panama ports, which were ostensibly the catalyst for the acquisition. This brings us on to the latest news about Hutchison's Panama concessions, which remain problematic. The Panamanian government's comptroller has challenged the semi-automatic renewal of the concessions in 2021. While there is considerable political pressure to annul the agreement, we believe the likely outcome appears to be curative action, which would see terms renegotiated to address the perceived shortcomings in the current agreement and to improve the outcome for the government. Regulatory challenges have also been raised in respect of the tender process for the STS-10 concession in Santos, with incumbent terminal operators in the port lobbying hard to be eligible to bid. The Port Authority in Barcelona has approved TIL's bid to acquire 50% of Hutchison's Best terminal, further strengthening MSC's position in the Mediterranean market. In our view, this is a network-led move with clear operational logic. It gives MSC a degree of control over a high-productivity Mediterranean node with excellent rail reach into Iberia and southern France, while preserving their options between gateway and transshipment mixes, especially useful at the moment while trade patterns remain unsettled due to the Suez-Red Sea disruptions. Finally, we reviewed the relaunched tender for the second container terminal at the Portuguese port of Sines as part of the government's Ports 5+ strategic plan. The terms for bidders for the €560 million concession have been revised, reflecting on the factors that saw the previous process that ran between 2019 and 2021 fail. While the new terminal will need to rely heavily on transshipment, it's thought that improved phasing and a clearer capacity context improves the chances of a successful tender process this time round. I'll now hand back to Dinesh for the conclusions and the Q&A.
Thank you, Eirik. Thank you, Eleanor. So key takeaways from the presentation before we move on to take some questions, which of course you can still ask using the questions panel on your screen. Talking about the positives first, we see the global terminal operators continue to invest heavily to expand existing terminal assets. More than half of projected capacity growth in next 5 years coming from assets already owned and operated by these companies. Drewry has also upgraded the demand outlook for 2025 on the back of stronger than expected market performance in the first half and a delayed introduction of tariffs by the US. However, these delays do mean that the outlook for 2026 remains low, with growth in global port throughput expected to be less than 1% next year. Finally, while we watch the legal proceedings in Panama with interest, you have to see this as a risk to incumbent operators who may find renewals and extensions more challenging as governments seek to rebalance these agreements in their favor. We have about 7 minutes to answer questions that you have sent to us during the course of the webinar. Please feel free to fire across any additional questions. We will attempt to answer as many as we can in the remaining time. And those that we are not able to address on this call, we will follow up via email in the next day or so. And also, as we previously mentioned, we will be sending out a recording of the presentation and a copy of the slides to registered participants. Right, Eleanor, perhaps I can start with you. What other deals are in the pipeline for MSC and CMA CGM?
Well, as I said during the presentation, their growth trajectory will continue. So our annual report took equity adjusted throughput up until the end of 2024, but there was a number of deals signed back end of 24 or early 25, which will boost growth. So MSC completed its acquisition of a significant minority share in German port operator HHLA in November 2024. So the full year impact of that, which handles around 6-7 million TEU across its portfolio, that will come through in full in 2025. And also earlier on this year, it completed its acquisition of a majority share in Brazil's Wilson Sons. Over the course of the year, MSC's TIL, Terminal Investment Limited, has also acquired new terminal assets in Altamira in Mexico and the neighbouring terminal in Ningbo in China to its existing terminal there. And it's opened a new terminal in Haiphong in Vietnam. It's close to closing the deal to take a stake in Barcelona. Just a few more regulatory hurdles to clear there. And its development pipeline is looking very healthy, with several new projects due to come on stream from 2026 onwards. And we mustn't forget that its African-orientated operator AGL is also made some investments across its portfolio and has acquired a new concession in Cape Town. So MSC certainly building its portfolios out there. CMA CGM has completed its acquisition in Brazil of Santos Brazil. It's also opened a new terminal joint venture in Khalifa, working alongside AD Ports. And it's also got a number of greenfield projects in development, including terminals in Egypt, Morocco, Vietnam, Colombia and Congo, which are due to come on stream over the next 3 to 4 years. Busy times.
Indeed, Eleanor. Thanks very much. Eirik, perhaps I can jump to you. There's still quite a fair bit of, as you mentioned, media interest and speculation with the BlackRock TIL CK Hutchison deal. What does the expiry of the exclusivity period between the BlackRock TIL and Hutchison mean? Is the deal off?
Is the deal off? No, absolutely not. But it remains very complex due to the multiple regulatory approvals required. So whatever ownership combination might be acceptable to one authority might well not meet the requirements of other governments or other authorities, or may not gain approval from the JV partners. The requirements of the push from the Chinese government that CK Hutchison include a mainland Chinese company within the bidding team will likely raise regulatory issues and approvals elsewhere globally, especially when you map that onto the Hutchison portfolio. Some have suggested that breaking up the portfolio may be easier, and whilst this is probably true in terms of regulatory approvals, we believe that CK Hutchison would prefer to exit the international ports market in a single transaction. All of which goes to suggest that this deal will rumble on for a number of years before it reaches a completion.
Thanks, Eirik. Indeed, the question is, who breaks up the portfolio? Is it the buyer or the seller? Right. Eirik, I was quite intrigued by the earnings graph that you had showed, which shows that earnings for terminal operators have 2x from 2019 levels. Can terminal operators continue to improve earnings if the market is going to slow down?
While a proportion of terminal operator costs are variable costs, a steep slowdown in volumes can quickly result in diseconomies of scale. Therefore, total earnings are likely to fall if there is a sharp slowdown in the market, and this will put margins under pressure. At the same time, a reduction in volumes is likely to lead to a corresponding reduction in the storage costs, which have been a good earner for the global terminal operators over the last few years, which will increase the pressure on the margin. So, yeah, in a nutshell, we expect that earnings may fall if the slowdown is as severe as we are currently forecasting.
Eleanor, anything you'd like to add to that?
Well, actually, looking at the questions, I think there's a question back to you, Dinesh, here about valuations in the market. We've got a large advisory team, of which Dinesh is a director within this. And the question here is about, do we think the valuation multiples that are being offered, in particular for the terminal portfolio deals, can be justified given the uncertainty in global trade at the moment?
Gosh, I wish you could have asked me a simpler question, Eleanor. Right. Look, fundamentally, we do believe container terminals, ports remain core infrastructure assets essential to trade. Yes, there are lots of headwinds, but equally, as you outlined, Eleanor, the terminal operators are doing a fantastic job of increasing asset utilization, sweating these assets, expanding within the existing footprints. I would say valuation is quite a relative thing. What some investors might find high, the others might find reasonable. I would say the financial investors would look at valuations in a very different way compared to industry players. For example, liner operators. I think Eirik mentioned some of the deals he was talking about where there was wider network benefits. So I think a lot of things need to be considered, both in terms of the type of investor, but also the type of asset. Clearly, the specifics of the asset are quite important. Where does the asset sit? What sort of a competitive environment is it operating in? And therefore, what is the risk to the ability to continue to generate revenue and drive volumes up? So I would say fundamentally essential infrastructure assets, as Eirik, you outlined, earnings are good and remain strong. Yes, there are some headwinds, but we do believe that the multiples would remain high. They're fair. If that is a question, the valuation multiples being offered, are they justified? They certainly in this current climate are.
Thanks, Dinesh. I think a lot of that comes back down to points that Eirik has certainly made before, which is about the very high barriers to entry. So when we look at some of the portfolio deals, these are really once in a lifetime. They're just not available on the open market. Therefore, valuing in particular for the industry players, valuing that unique opportunity to access a market and leverage the inland transport opportunities and that supply chain presence is really key there.
Absolutely.
Any more questions that we're already a little bit over time?
I think we can discuss this at length, Eleanor. This is one of the sectors and segments where you can spend the entire day, if not more, talking about it. Indeed, conferences are organized in multiple days talking about this sector. We do have a lot more questions, but we've run over time. So let's conclude the webinar for today on Drewry's latest insights into the ports and terminal sector. Of course, we are quite happy to chat about the sector. We would like to thank you very much for your participation. If you have any follow-up questions, please do send them to us by email using the email address on your screen, enquiries@drewry.co.uk. If you'd like to view and listen to a recording of this webinar, we will be posting a link on this on our website, www.drewry.co.uk. Thank you once again, and we look forward to your participation at future Drewry events.
Thank you.